All right. Hello, everyone. Nice to be here this morning. Nice to be the very first speaker. My name is Andy Fleury. I'm from Switzerland. I used to be an Air Force pilot in Switzerland, and I used to work for the Swiss intelligence agency, like the Swiss NSA, for some time. I used to be a hedge fund manager for quite a few years, and then in 2014 we started AlgoTrader. So AlgoTrader is an algorithmic trading software solution for hedge funds, for prop shops, for banks, for family offices. And we basically provide everything that you need to automate your trading, anywhere from back testing to live trading to reporting, reconciliation. All of those are included. We include all asset classes. Originally, we did a lot of FX, equities, derivatives, but also 2 years ago, we started offering cryptos. And we were actually one of the very first solutions to offer automated trading of cryptos. And over these 2 years, we built a lot of experience in this field. And I'm also going to talk a little bit about that. But let me start with the main topic. What does it take to make your algo profitable? So where do you get ideas for a profitable algo if you don't have one already? Typically, a good idea is to look at market inefficiencies. There are many of those. There is, the implied versus realized, and many others. So a lot of times you get good ideas from academic papers. There are a lot of those. So the deal with those is you have to verify that the findings are actually correct. We discovered many times that some findings were presented, really good looking returns, and then you build it yourself, and no, it's not true. They didn't factor in fees, they didn't factor in slippage, so you have to do your homework. Also, these days there is social media, and a lot of traders, be it retail traders, but also institutional traders, they brag about their returns. And they give you a lot of information for free. So if you follow, platforms like TradingView or Quantopian or Quant Connect, even though there are a lot of retail traders on there, but you get a lot of institutional guys as well. So and they often share a lot of information with you where you can gather ideas. Obviously, you have to know your financial instrument. You have to understand it. You have to understand the nature of it. What you want to avoid is having a strategy that is profitable just by pure luck. So you want to have an economical reasoning, an explanation why your trading strategy is profitable. That's very important. So, some ideas how to get started. The first one, it starts easy, start simple, but it's very important. We often have clients come to us and ask for our help to implement their trading strategy, and it's already extremely complex. You don't want to do that. You want to start with something very simple. A few simple rules, maybe 1 or 2 or 3 parameters. You can always add complexity as you go, but you can never go back. If your system is complicated, making it simpler, that just doesn't work. So really, try something simple, add something, add a filter, add a new rule. If that doesn't increase your performance, get rid of it. Try something else. Try to keep the logic as small as possible. And then there's the topic of parameters, number of parameters. We sometimes have clients come to us that want to build a strategy with 15 parameters and want to do parameter optimization of those. That just doesn't make sense. From our experience, it's usually not more than 2 to 3 parameters that really define the performance of your trading strategy. So you want to figure out what are those 2 to 3 parameters. And many times if you have 10 or 15, all the others are not adding anything to your strategy. So if you have an idea, if you have a strategy, you have a back testing, what does it take to go into live trading? Obviously, you need to select your broker, your exchange. You have to factor in fees. What are what's the commercial side? How difficult is it to get onboarded? I'm assuming you're familiar with all of that. Second one is you need to have a platform or a software that does all of that for you. An advice from my side, don't try to build something like this yourself. You'll end up spending magnitudes more than you expected. Seriously, I've seen this many times. I've seen it more than 10 times. People trying to build something themselves and then gave up. And then luckily they end on our doorstep. Also, you want to be sure that you have the same system for back testing and for live trading. I've seen many cases where companies had a nice back testing system, built in Python, and then they had some other guys build a live trading system for them with C++, C# or Java, and that often leads to issues because you don't know that the logic of your live trading system is the same as the one you had in back testing, so you want to avoid that. Then speed and latency. Is your trading strategy latency sensitive? If so, then obviously the location of your system is important. Does it need to be co-located? Can it be on a cloud? Can it be on an on-premise server? Those things are important. If your strategy only trades once a day, you can neglect all of that and you can run it in the cloud in AWS or something like that. Then the coding part, who's going to do the coding for you? You need someone to code it for you. From experience, a good software developer with a computer science background is usually better suited for that task than a quant with a mathematical PhD. These got nothing against quants. We need them. They're good at finding models, back testing them, doing research. But for building a live trading system, usually a good software developer will be better. Obviously, you can also ask for help. Our company, for example, we help clients implement trading strategies. Over the years, we've built over 100 of those. So we have a lot of experience in that field. Then another important topic is monitoring of live trading. Yeah, we're in the field of automated trading, so you could assume that everything runs fully automated. Yes, in ideal case, but you need someone to monitor the system. We always recommend to our clients, while the market is open, somebody should be there to monitor the system, and that person should have an emergency plan, what to do in case something goes wrong. If you lose connection to a broker, what number to call, what to do if your internet connection is down, things like this. So you have to prepare, we call it business continuity. So you have to prepare for that. Then the last one I'd like to mention, because it always gets forgotten, and it's about trading hours. So obviously, when your product is traded, but very important is also holidays. We've seen it so many times that on December 24, when the markets close early, people still have a position that they end up keeping over the holidays. And that happens so many times. So pay attention to holidays, late opens, early closes, especially if you're trading around the globe, multiple time zones. So, trading holidays are not the same. in different locations. So how can you improve the performance of your system once you have a strategy? Obviously through backtesting, that's an important part. You have to pay, when you're doing backtesting, you have to pay attention to common mistakes, like the look-ahead bias, for example. There are many of those. So you can do backtesting the right way and the wrong way. Obviously you have to factor in fees, slippage, commissions. These things often get forgotten. When you're doing backtesting, you assume that your trades get executed 100% at the current market price. Now that's often in real life, that's not the case. So you have to factor that into your backtest. If you're trading equities, obviously you have to pay attention to dividends, to stock splits, delistings. That's another common mistake, that people don't pay attention to delistings, and this is actually called the survivorship bias. Have a look at that if you haven't heard of that term before. Obviously, if you're trading futures, you need to pay attention to rolling. There are many ways to roll your futures. Possibly just the last trading day might not be the right idea. There are many ways to do rolling. People always think there's just one way to do futures rolling, but it's not. There are quite a few ways to do futures rolling. Another one is data sets. Don't just use one data set. A good idea is to use one data set for your backtesting, for your optimization, and then use another data set for your verification. This is called A/B testing or walk-forward testing. Then parameter ranges. Another very important part. So your strategy has parameters, like I said in the beginning. You don't want to have more than 2 or 3. Ideally, you're going to do parameter optimization, of course. What you want to do is you want to look for a stable parameter range. So you want to look for a flat hill where when you modify your parameters slightly, the returns should still be somewhat the same. So you want to avoid steep peaks. That's not a good situation. Obviously, paper trading. So when you're ready to go live, don't use your big account, your all your money. Start doing paper trading. Use a sandbox account, and then when you're really sure you trust your system, use small exposure that you slightly increase over time. Good, and then I have a last slide with just some best practices from our experience. Often inexperienced traders trade one instrument only on one market. You can do that, but there are better ways. We always recommend trade multiple instruments, multiple markets, multiple asset classes. Ideally, even trade multiple strategies on multiple markets, on multiple instruments at the same time. That typically gives better returns. Position sizing, money management. Don't trade all in, all out. Common mistake. It's usually better to gradually blend into a position and blend out of it. Much better than trading constant sizes, throughout the day. Adjust your exposure. So, in terms of high volatility, you want to trade smaller positions, obviously. Good thing to follow. Take profit and stop loss. That's usually a good thing. When you had some nice profits, you wanna when you had a good run, take a little profit. Don't close the entire position. Let it run some more, but take some profit. And having a stop in place with a market order, not a stop limit, not a limit order, because you want to get out if the stop gets hit. that's a good idea. Another one is common trading strategies. I mentioned, following social media, you get a lot of ideas about trading strategies, but trading a moving average crossover strategy on the euro dollar is probably not the best idea. There are millions of people that do that around the globe. So, chances are somebody's doing it better than you, faster, and will eat your lunch. So try to avoid that. Try to find your own edge, your own strategy. Manual intervention, another one. We see that so many times people build up, strategies on their own, fully automated, and then they manually interact with the strategy, and that's a very bad idea. Monitoring the strategy while the market is open, mentioned that one. Prepare for the worst case. Prepare for market corrections, but also prepare for technical issues, because they will happen. In live trading, you're the biggest bug of your strategy, you'll probably only notice in live trading. Seen that so many times. Good. So those were some general rules about trading, because we do a lot of advice also in the crypto space. I'd like to add a few more things also around cryptos. So, the market is very fragmented today. There are about 200 exchanges, not very reliable. There are now, big exchanges, institutional exchanges coming up. There is the BACT, there's the CBOE, the CME, there is the Deutsche Börse in Germany. So big exchanges are now moving into the space. But right now, when you're trading cryptos, you have to work with crypto exchanges. The problem with those is that you need your assets on the exchange, and this is often what hedge funds don't like, and banks. They don't like to have their assets on the exchange. Technically speaking, this is a bit of an overview. Most of these exchanges will provide APIs for market data, trading, historical data, all of that. So that's good. The problem is that every exchange API is different. So there is no common standard. In terms of protocols, most exchanges use REST and WebSocket. Some use FIX, which is in our understanding the best option. Most of them don't support it. So you have to deal with those other protocols. There are also some intermediaries that you can work with, but those typically don't work. Obviously, you can also work with brokers and market makers. They will help you with big orders. They provide things like execution algos, smart order routing. They will provide streaming quotes to you. So for large orders, that's typically a good idea. And they also provide post-trade settlement, so you don't have to have your assets on the exchanges. I'm gonna skip this one. So this is us. Just two more things about our company. Our vision is to be the preferred algorithmic software solution provider for capital markets disrupted by blockchain. So again, we provide everything a typical trading company needs to automate the business, all asset classes. This is our system. If you're interested in it, please come see us at booth 319, just behind that wall here. We're happy to show you more. This is what our system looks like. It's a browser-based application. It's used by 50 clients around the globe. Few facts about our company here, but I'm out of time, so I'll leave that slide hanging here as it is. Thanks for your attention. And yeah, if you have questions, please come see me, booth 319. Thank you.